In this week's update, the Fed was less aggressive than expected, but what comes next? And mining and energy will continue to diverge massively from the rest of the market. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. The expectation was that the Fed could even go as high as 0.75% rate increase through the week. They didn't. They settled at 0.5%, and Jay Powell made it pretty clear that 0.75% increases in the future were not on the table, and that it would be 0.5% maximum. The market loved it for at least a day and rallied very, very strongly. But the correction's going to continue, and we'll see why when we look at the spread charts, because that's really telling the story. It's about the continued very considerable rotation from aggressive sectors, growth sectors, into value sectors. So this was a classic case of selling the rumour, short selling the rumour being 0.75% was a possibility, and then buying the news. And when the news came out, the people that had been shorting the market reversed their position. They had to buy back their positions. So everybody runs over to the same side of the boat. Everyone's a buyer, hardly any sellers. And we got a short covering rally that would rip your face off on Wednesday. But it only lasted a single day, whereas in March it lasted 3 weeks. From the middle of March, we got a very strong reversal that did include a rotation back to growth that was undeniable and it was powerful. But this time it only lasted 1 day. And Thursday night we were back down again, and Friday as well to a lesser degree. So while this rotation from the aggressive growth sectors of the market continues, then markets are at much higher risk of lower levels at the index level and also at the individual stock level. And that's just the reality of it. So we're having an unwind of multiples, and I've been talking about this for months. The growth sectors of the American market, the multiples were a function of 4 decades of continually falling interest rates, and the expectation was that interest rates could possibly stay low for many, many years. And so no one was thinking about the fact that the cost of money was going to go up and that inflation would break out, because for so long, for a decade or more, inflation was expected to rise significantly but never did. And so people were lulled into a false sense of security. And the focus came onto stocks that had enormous growth but no profit. And we saw that in Australia with Afterpay Touch was probably the classic example. And everyone just started to accept that a new normal applied, that it wasn't about profit, it was about growth in revenue, and the profits would come later. Well, that's all changed now because interest rates are going up, and we'll look at the 10-year yield curve shortly. This multiple contraction, and I said it in the middle of March when the market turned around, I didn't like the turnaround because I didn't feel that the multiple contraction had gone far enough. It just hadn't gone for long enough. The market hadn't got bearish enough, and the multiples had not come down far enough. We still had stocks with no profits and no prospect of profits trading on multiples of 20, 30 times sales, not profit, but sales, which is just crazy. And so that multiple contraction is now well and truly underway again. And even though some stocks have fallen 60, 70, 80%, they could fall in half again without any problem at all. So this great unwind is going to continue, and you want to be very careful if you're trading growth stocks in America. I expect that the volatility is going to remain elevated as well, because there are just so many issues out there that everyone's aware of. I'm not going to list them, but there's a huge amount of uncertainty and there's a huge amount of change, and we're in an environment where the market is struggling to reprice assets under a completely different environment from what we've seen for the last 4 decades. But through all this, the valuations of emerging miners is a really interesting point. And it's going to be very heavily subject to short-term sentiment. And I want to use Chalice in Australia, Chalice Mines, CHN, just as an example, this is not a recommendation, but it's just an example of the fluctuations and the volatility that we're going to see, particularly in mining stocks. Now, I think everyone has an appreciation that with decarbonisation and electric vehicles, that battery material stocks have got an incredible future for the next couple of decades. But sometimes these stocks just get overvalued too quickly. And if we look at Chalice, and there's no question that Chalice is the best, or one of the best global discoveries of nickel, copper and platinum group element metals in the world in the last 2 decades. So it's an absolutely world-class project, and they're only just scratching the surface. This could be absolutely anything. But the market just got too excited, and back here on the 17th of November, the market cap was $3.7 billion, which for a company that had only made its discovery not much more than a year before that was quite a healthy valuation. But the price has come back now and is only 2.5 billion, so it's lost nearly a third of its value between November and now. So it raises the question, what is the right valuation? And you can take this example across just about every emerging mining stock in the Australian market. What is the right value? And the answer is that no one knows, but let's look a bit more specifically at Chalice. The Gonaville discovery or resource covers only 7% of what is more than 30 kilometres of prospective ground, and they've got other targets as well in different areas of the state. They've got a scoping study, and that discovery that they've made is whilst it's only 7%, is already huge. It's the biggest one in the world in the last 20 years. There's a scoping study due in the third quarter, and until that comes through, I haven't been able to get my hands on any sort of estimation of what the project value might be in the future. So we really don't know what this is going to look like. The company's got no debt, it's got cash of 55 million. So that's the current position. But what is fair value? Is it 3.7 billion? Is it 2.5 billion? Or is it 1 billion at this point in time? And it depends very much on short-term sentiment. And no one knows the answer to that. And that is the dilemma and the opportunity in trading these sort of stocks. Longer term, a project of this nature, as it's unfolding, the long-term market cap is probably far higher than 2.5, probably, but we don't really have a feel for it yet. So for me, these become a management exercise. It's about being clear about what you're doing, what is the purpose, what is your time frame, and what are your expectations, and how do you enter, and how do you take partial profit along the way. I've had emails from some people who aren't some traders who aren't members of any of my services, and they've inquired what is wrong with Chalice, or what is wrong with something else. Why has the price fallen 33%? And the conclusion is that because it's fallen 33% or 50%, there must be something wrong with the company. But there's absolutely nothing wrong with the companies. Nothing has changed. This is just the market at different points in time assign a different value. And it doesn't reflect if the price is going up or down. It doesn't reflect that anything has changed in the company. And I think that's a really important point to remember, because we've got some of the most wonderful opportunities over the next decade that can be absolutely life-changing in financial terms, but they're going to be extremely difficult to live with from time to time. And so perspective around what you're doing in the Australian mining sector is going to be really, really important. Now, overall, commodities remain an excellent inflation hedge. That's always been the case, and there's no reason why that won't be the case in the future. And then we've got the added bonus with commodities this time round is the outlook, the whole decarbonisation theme. So if you want to sleep well at night and take advantage of these opportunities that the Australian mining sector is going to offer over the next decade, then you need to be very clear and very sharp in your perspective about what you're doing with these stocks, and trade management is absolutely critical. And in the best part of 20 years of mentoring thousands of people, my experience is that the majority really have no idea about such things, about the purpose and clarity over process. So it's going to be essential as we get into really get into this unfolding of the mining boom in Australia. Now, what do we need to see? So the US market's going down. The Australian market had held up very well, but got absolutely murdered the last couple of days of last week. What do we need to see for a major low in the US market, and therefore for global equities to start to turn up again? Look, there's a number of things that I look for, but these are the main ones. We need to see money flowing back into the growth sectors while the S&P is flattening or perhaps even still falling. So that's the first thing. The second thing is that the ratios in the options market, the number of puts that are being held compared to the number of calls that are being held, is still too bullish, or to put it another way, is not bearish enough. Not enough people have gone to the extent of buying put options to protect themselves. They're not fearful enough. And until we reach that point, then the excessive bullishness that was in the market built up over many years has not washed out enough yet, and we haven't seen the lows. So that's another really important indicator. So let me just take a look at the VIX index. The yield index. So this is the 10-year yield. Let's look at it over the last 3 months, and you can see we were sitting around 1.6, 1.7 just 3 months ago, and now we've breached 3%, and we finished the week at 3.128. So this is what is causing this dramatic revaluation of the market. You know, it's the response to a number of things that are happening in Ukraine, and therefore with food prices and energy prices. But it is part of the reversal of a multi-decade situation. So let's look at American stocks. The S&P amazingly only fell 0.2% for the week. But along the way, there was the worst index session of the year on Thursday. The market was, I think the S&P was down about 3.3%. The NASDAQ was down by over 4%. So it was a very significant down day, but it had been preceded by an incredibly powerful rally. So the net was not much change in the S&P. But underneath, when you looked at the individual stock level, and particularly if you're looking at growth stocks, it looks very ugly, and there's almost certainly more to come. It is very oversold, though, in the very short term, thanks to what happened on Thursday and to a degree on Friday. So we may see a short-term bounce, but the direction is down. Now, the US dollar index was higher to 103.66, so that's the expectations about the direction of US interest rates relative to particularly Europe. The 10-year yield peaked at 3.14 and finished at 3.128. The VIX spent the week ranging between 25 and 35, which is high. And for the lowest level of the VIX to be 25, that tells you we've got a pretty nervous market on our hands. But for other reasons, we still haven't peaked yet. So let's look at those other key charts. So we'll start with, we'll have a look at the S&P first, just to get the overall perspective. So there's the S&P, really strong reversal on the big sell-off on Monday, but it regathered itself and finished slightly in front. Better day on Tuesday, up a little bit, Wednesday was massive on the Fed announcement. And then Thursday, it immediately gave that all back and some. And then Friday, we were again down, but closed about where we opened. So pretty much the midpoint. So an absolute roller coaster for the American market. And if we look at QQQ, which is the ETF covering the NASDAQ, you can see it looks a lot worse than the S&P. Let me just go back to the S&P for a minute. So I want you just to look at the relationship of the index to the moving averages and what the moving averages are doing. The 200-day moving average is now rolled over, but only just, and the actual index is not that far below the 50-day moving average. But when you go to the NASDAQ, you can see we've actually broken support. So the NASDAQ is clearly doing worse than the S&P, and the most accurate way to look at that is to look at the spread charts. So we'll start first of all with the NASDAQ versus the S&P, and this is the ratio chart. So the line is falling, means the NASDAQ is underperforming. It's doing worse than the S&P, and it's very clear that we're forming lower highs, lower lows, and the trend is quite significantly down. And even during those 2 days, Monday and Wednesday, when we had quite sharp reversals in the S&P, the NASDAQ outperformed a bit, but not much. So look at the ratio rise on the up days compared to what happened when the market went overall was down. The NASDAQ did significantly worse. So when there's buying, there's a little bit more buying going into the NASDAQ, but when there's selling, there's a lot more selling going into the growth sectors of the market. This is consumer discretionary versus consumer staples. Same situation. Consumer discretionary continuing to fall apart very significantly. And this is really interesting because the American economy is not in bad shape. It's not heading into a recession. It just isn't. And if you look at the 10-year, 2-year yield spread, it's now back up to 0.4. So the American market is not heading into a recession. That is not the cause of the stock market falling. This is an unwind of multiples that are no longer justified in a different environment, in a rising interest rate environment. And whilst American households are in pretty good shape with less debt and more cash than they've ever had, so this is not about selling consumer stocks or consumer discretionary stocks because the market is fearful that the consumer is going to close their wallet. This is about the multiples getting unwound. And that is the reason I make that point so clearly, is that that's a different scenario. If the situation was that the American consumer was running out of buying capacity, that is a much more serious issue. Whereas a multiple contraction unwinds to a certain point and then it's done. It's over. And the market is then free to go back up again. So this is a really important point, that this is just a multiple unwind. This is not the consumer feeling the pressure. If inflation continued, however, that could be the case. But I'm still open-minded that we might start to see inflation, or the comparative inflation numbers compared to the same month in 2021, start to moderate. And it could well be in a month or two that we're hearing a very different rhetoric from the Fed about what they need to do to combat inflation. This is the Russell 1000 growth versus value, still clearly and strongly to the downside. Small cap growth versus small cap value, same story. So it's very, very clear from the spread charts that the rotation from growth to value is if anything, accelerating. And whilst that's happening, we're not at a market bottom. And I still think that 3,800 in the US, in the S&P, is still a possibility. And just while I'm here, this is GDX versus GLD. So this is the miners versus the gold price. You can see with the ratio line rising very, very strongly, the miners were outperforming. That's all changed since the middle of April, and the last 2.5 weeks, it's been strongly back down again. Miners underperforming the gold price, but we'll come back to that. So I think I've covered all those points. The 10-year, 2-year spread is back up to 0.4. So that's everyone got themselves in a fluster over a looming recession that the bond market is now saying is not going to happen. Turning to Aussie stocks, our dollar with the strength in the US, despite what the commodity outlook is, our dollar was lower, just a tick over 70 cents, but had dipped down below 70. Our index, however, lost 3.1% across the week. We may see a bit of a rebound on Monday because the selling on Thursday and Friday was just so concerted. And there certainly was an element of panic selling on Friday, and it even got into the mining stocks, which is why I talked about the Chalice example earlier on. The Australian mining sector got absolutely slammed, and so if you didn't have an understanding of what was driving the market, you'd be tempted to think that the Australian mining sector was in trouble. But clearly it's not that. It's just there was panic selling, and it was really, to my eye, it was more of a buyer's strike. The buyers stepped back, and we had perhaps inexperienced traders at the margin panic selling into a very thin buying depth. And so prices can move a long way quickly when that happens. But the market will stabilise, and the prices of mining stocks, of great mining stocks, will go back up again. On a 2-year view, there is an absolute smorgasbord of enticing projects. I've never seen, in my 35 years in the market, I've never seen so many mining opportunities. And it's because of decarbonisation and electric vehicles. The outlook for commodity prices and commodity demand has never been this robust, in my view. So there's a terrific opportunity to make a lot of money out of mining stocks in the next 2 years, 5 years, 10 years. It's just the part in the middle. It's dealing with the volatility that is the challenge. And unless you're clear about what you're doing, then you're probably going to find it very, very difficult and very challenging. Let's turn to the Australian market now. Just a couple of other charts that I want to look at just before we get to the Australian market. This is Amazon. So Amazon broke down. We had several key support levels that broke. The first one was here. We had a breakdown in January. It then went up and down, and it seemed as though the really big tech stocks were going to resist the sell-off. But then eventually the market caught up with big tech, and at the end of April, Amazon then broke another support level. And you can see what happened over the last week to 10 days. Now we're back down to likely support levels. There's a couple of support levels here, so think of it as a band somewhere between 2180 and 2250. So we may get a little bit of a blip here, and the nature of the blip, what the size of the candles are, what the volumes are associated with them, will tell us a great deal about whether Amazon is likely to hold this level or whether it's going to go down further. And the point about that being, whether you trade Amazon or not, is that if Amazon breaks this level, and you can say the same thing about Google and Apple and all those stocks, if they're going to break those levels, then the indices are going lower. The Nasdaq is going much lower, and that'll keep the lid on sentiment, and that'll make it more difficult for other stocks to perform. So that Amazon chart, whether you're interested in owning it or not, is a really important one to watch. The other one that is also a really key one, this is an ETF that gives us a wider spread of stocks, the main ones being Amazon, Google, Cisco, Facebook, which is now called Meta, Salesforce, Netflix, PayPal, and Airbnb. So they are the main constituents of this ETF, which is codenamed FDN. And there's just no question about what's going on with FDN. And we've broken some significant support and would appear as though it's continuing to head lower. So there's not much argument about where the American market's going. Let's just look quickly at the indices. So there are some bright spots. This is XLE. So the energy sector in America is clearly doing something very different. So this is where you need to be very specific about what parts of the market that you're targeting. This is XLK, the technology sector. It's clearly in downtrend. XLY, consumer discretionary, is the final one that I want to show. Now, just coming back to the Australian market, let me start first of all with the ASX 200. So you can see very, very heavy selling on Friday, and I think the short-term fate of our market will depend a lot on how we respond on Monday morning to what happened in the US. So that's the ASX 200. If we look at the emerging companies index, which is an interesting one, XEC, you can see it's been all downhill now for a couple of weeks. We didn't really get the bounces here that we got in the main index. Energy has done well here. Finance, sorry, that's not finance. This is finance. Finance is also has been holding up quite well, but certainly fell quite sharply on Friday. Healthcare has been well down but stabilised for quite some time. And materials also took it on the chin on Friday as well, after some heavy selling the week before. And finally, the small cap index. So the message here is you've got to be very specific about what parts of the market that you're targeting. Turning now to precious metals, gold lost 14 down to 18.84, and look, it's been twisting my tail for probably since the middle of 2021. It's just very frustrating at the moment. Gold just doesn't seem to be able to gain that momentum. And precious metal stocks, well, they're now underperforming as well. So let's have a quick look at gold. All right, that's gold on a weekly basis. We did manage to spike up in March to a double top, but since then, over the last couple of months, it's sagged back down again. It's not dead, but it's certainly not showing the momentum that we'd like to see, and that's gold on a daily basis. But if we go to let's look at GDXJ, you can see after we peaked on the 18th of April, it's been all downhill, and it's fallen basically from 52 to 42. So we're off around 20% in global gold miners. Other commodities, copper fell and nickel also fell under the weight of the US dollar, continuing to weigh. But this is not a demand situation, and I don't believe that this is related to global economic growth concerns. I think this is purely about the US dollar. Crude oil went up to $111, so it's back on the rise again, and that's certainly not helping inflation. There's the spot copper chart, so you can see quite a sharp fall from $4.60 down to $4.23 in the last couple of weeks. Nickel off, not off quite so much. So wrapping things up, last week, and I just thought I'd recap on this. Last week in the video, I said in the US it was advisable to raise cash and possibly hedge your exposure. So I hope that you thought about that, and if appropriate for you, took some action to do that, because it certainly would have insulated you in the US. In Australia, I said with commodity stocks, you just need a clear plan and a good unemotional trade management. And if you didn't have that on Thursday and Friday, you were probably tearing your hair out. So that's what I had to say last week. I want to add to that some other perspective. If you've got a plan then holding strategic cash, so cashing up, is a wonderful asset. Cashing up just to go to cash is not advisable. We've got a rising inflationary environment. Cash is one of the last places you want to be. But if you've got a clear plan and you're raising cash for strategic purposes to buy back in, and you're going to sit on that pot of cash for a few weeks or a few months or even maybe 6 months, waiting for very clearly defined opportunities, then that's great. It's an asset. So, I have no problem with using cash in that form. In fact, when you think about it, some people have suggested that maybe we should be buying defensive stocks. Well, I question that. Why would you want to go into defensive stocks, which, okay, might fall less than the rest of the market, but they're still falling? And if you're going to park your money in defensive stocks, what do you then do when the market bottoms and turns up? Do you then have the choice of having to sell your defensive stocks at a loss? Okay, it might only be a small loss, but it's still a loss. Why would you want to do that? Whereas if you went to cash, you haven't lost any money and you can immediately start buying back into the market. So I don't understand the logic around buying defensive stocks. You don't have to be in stocks. You can be in strategic cash. The other essential asset that you've got to have is just have a clear plan about what you're doing. It's just so important. So the actions to consider, this is just general advice. This is just providing perspective that, maybe gets lost in all the media noise. I think everyone needs to do things to break that emotional reaction to seeing a sea of red on your screen. And let's face it, Thursday and Friday, particularly Friday, was horrible in Australia. Well, there are some very simple things that you can do. Just, don't look at the bottom line on your account. If you want to know what the stocks are doing, then look at a price chart. Virtually every online broking platform can give you a price chart. So just look at that. Don't actually monetize it, because that then engages an emotional reaction. So there are things that you can do just to make life easier for yourself. The bottom line is that this sort of panic selling that we saw on Friday just sets up wonderful long-term buying opportunities. Now, we may not be there yet, but they're coming, because we've got some unbelievably good projects in Australia that are now trading on very, very small market caps compared to the value of those projects. So I think it's advisable at the moment. I expect that markets are going to continue lower for a bit longer. So, raise cash levels to a level that's appropriate for you, but be alert to load up in commodity stocks when the signal is there, not when you guess at it, but when the market is telling you that it's the right time to be loading up on those commodity stocks. Then, be alert to it and be decisive and take some action. Now, Portfolio Analyst last week was a break week, nothing doing. I had 4 weeks off a year from the research effort that goes into Portfolio Analyst, and it'll be back on this week. So that's it for this update. There's more information on the website. There's my email address, and I'm sure we'll have probably another pretty volatile week on our hands. I just don't see that changing for some time. So we'll see what happens, and I'll be back with you next Sunday. Cheers.